Welcome, everyone. This is Tony Martinez of the CDPE. I'm so glad to have you all here today. We are very excited to have a very special guest today. We have been doing this for a while now. We've been inviting some of the folks that are like most renowned in the industry that are out there shaking things up, sharing information that the other ones just won't or are too afraid to do. And today is another one of those situations. I had the pleasure of being introduced to John through Melody Wright. I think a lot of you were on that call where we interviewed Melody, and then she was gracious enough to interview me afterward. But I love what John has been posting on X, Twitter, Twitter X, whatever you want to call it. And the first time I read his stuff, I went, whoa, hold on a second. Someone's actually has the guts to go ahead and share this information. And it's so in line with what I believe is happening and is going to happen, what Melody believes. And this is way overdue. So, John, I can't thank you enough for taking time out of your busy schedule to be on the call with us today. How you doing?
I'm doing well, and I appreciate the opportunity to talk with you and your crowd today.
Fantastic. So tell us a little bit about yourself. Where you hail from Florida as well, right?
I do. I'm from the Jacksonville area. Um, I I spent about 20 years or so in the mortgage technology business, largely designing and developing the tech systems that power mortgage originations and mortgage servicing, default servicing. I built a couple of loss mit systems, some foreclosure referral systems, along with kind of the whole gamut within originations and servicing. So that's kind of my background, and at that core background is a background in data, right? And in the mortgage world, there's lots of data, and I was responsible for marshaling that data to the applications as they needed it, and also doing analytics, figuring out what the data means, that sort of thing over my career. And that was kind of all before I left the W-2 world to start my Substack and bring some of this mortgage data and the analysis off of it, the mortgage data that's publicly available from Ginnie Mae, and then some that's available from Fannie Mae and Freddie Mac, and bring that analysis to folks who are interested in it, which of course now, particularly with what's about to happen or what's happening now with FHA loss mitigation procedures, lots of people are starting to become interested.
Yeah, and you were around during the great financial crisis, right? So you were in the thick of it back then, huh?
I was. It's funny. It's interesting to listen to Melody talk about her experiences in the GFC, where she was kind of seeing it more from a business, and helping with the top of the house try to keep the companies that were under stress in business. And I saw it from a completely different perspective. I saw it from a technology developer's perspective, where we're trying to build systems for mega clients, right? The Wells
Right.
Fargos of the world, to try to keep their heads above water as they were processing through foreclosure referrals. I mean, I've never felt pressure professionally to deliver at any other point in my career like I felt pressure. It's just because the need for it was so much. Like a 3-month delay like truly was disastrous for the client as opposed to just being disastrous on paper. So it was a heck of a time to be in the mortgage industry, whatever facet you were in.
Yeah, and I was there with the CDPE, going across the country teaching real estate agents how to do short sales, which back then, when they first surfaced, and it was like, what? What's a short sale? People had no clue what we're talking about. The industry really wasn't ready. It just wasn't the industry. I think it was everyone, right? The servicers, no one really knew what was going on. So it was quite a tumultuous time for our country. And I would like to ask you, since you were there then and here you are now, are you seeing any similarities?
Uh, so to a degree, like some similarities and some differences, right?
Mm-hmm.
From a similarities perspective, um, I think there's a little bit of a malaise that hangs over people, particularly when you've got a stock market that's doing so well. Uh, and also, I mean, in all honesty, if you look at the Fannie Mae and Freddie Mac delinquency rates, like their numbers look good. And so I think people kind of get lulled into a sense of, well, everything's good everywhere, right?
Right.
And like in the GFC, I mean, there were pockets where things were absolutely awful, like in particular the residential mortgage-backed securities back then, which were not many of which were not publicly backed. I mean, they became publicly backed when the GSEs were put into conservatorship, but the there was and then all of the derivative products off of those mortgage-backed securities. But people didn't kind of understand that no, there was a significant chunk of there's a significant chunk of the mortgage base that was truly, truly distressed, and when that hit the fan, that was going to kind of blow up the securitization. And I think you see some of those similarities now, like particularly in the auto space with the auto asset-backed securities, which really are starting to kind of blow up. Uh, and and there's definitely a reckoning to come within the FHA space for effectively all of the distress that's been bottled up over the last 4 or 5 years since the onset of COVID, that will now start to be released over the next 12 to 18 months. But there's some differences. There's some differences as well in the mortgage space. The biggest difference is that most of the country's mortgages are federally backed, right? Either they're FHA or VA, or their Fannie Mae or Freddie Mac, right? Which, since the conservatorship, that guarantee has essentially been explicit, which means a couple of things. One, it means that, like, what happens in loss mitigation, and loss mitigation isn't just loan modifications and home retention options. Loss mitigation, of course, also spans the short sale process, deed in lieu, the various other disposition loss mit tools that are available before a loan goes to foreclosure. The process and procedure around that is now much more governed and regulated than it was back in the GFC and the immediate aftermath, right? Where that was pre-CFPB, so you got their rules in play, but then the actual kind of policies of how and what to do for, like, the vast majority of the country's mortgages, and honestly for the big pockets of distress, which are in the FHA and to a lesser extent
Yeah.
the VA world. Those procedures are kind of define what you're going to do centrally. Like, the servicers don't have a whole lot of leeway. They kind of have to follow the playbook that the FHA or the VA sets for them.
Okay. Oh, so let's go ahead and focus in, because as you mentioned, and I agree 100%, when the general population looks at mortgage default, what you constantly hear is that the mortgage defaults are historically low levels, and what they're factoring in is they're factoring in all mortgages, right? And we know that the typical conventional borrower at this point in time, and maybe never, is not in default, or the vast majority are very current on their mortgage.
Yeah.
For months now, maybe even longer, I've been out there, like John the Baptist in the wilderness, saying, guys, yeah, I know, but there's FHA. And let's face it, after the great financial crisis and subprime loans went away, what took its place? FHA mortgages became the new subprime mortgage.
Yep.
Without FHA, many markets would not even exist. And what people don't know, because a lot of them are just not paying attention, is that as we stand right now, 1 in 10 FHA mortgages is in default. 1 in 10. In fact, I heard one stat, you could tell me if this is right or wrong, that out of 131,000 new defaults, 90% of them were FHA, yet FHA only accounts for 15% of all mortgages. And that just scares the hell out of me. And then you came out with information that just kind of rocked the world in terms of, yeah, but do you know what's been going on behind the scenes? So if you could go ahead and just, man, take it away. What is it that you found out? What kind of led you to want to check into what's going on
Yeah.
with FHA, the mortgages, the servicers, that I think a lot of our listeners, they're really not familiar with some of the stuff that's been going on behind the scenes and what's coming.
Yeah, I mean, it's honestly, it's sort of nuts, Tony. Like it's an almost unbelievable story, except that it's true. So what prompted me to start looking was, I thought, hey, I'll present data on FHA delinquency because I figured, look, FHA delinquency was going to rise one way or the other. We probably had that K-shaped economy where the top part of the K, the top 10% are doing pretty fine, but then you get to the bottom 90 and it's a lot hairier, and that wealth disparity's kind of been continuing to be exacerbated. So the natural knock-on effect of that would be that, okay, well, FHA mortgages are probably going to continue to struggle. So I started grabbing the data from Ginnie Mae and loading it into a local database so that I can see what's actually going on in the FHA mortgage sphere pretty well, and just to kind of put context around like what data I actually have. So every month, Ginnie Mae, who is the issuer for all of the mortgage-backed securities, where FHA loans mostly go into, right? The FHA portfolio is about 8 million loans, give or take, and 6.8 or 6.9 of them are in, actually it's a little more, it's closer to 7.1 million are in Ginnie Mae mortgage-backed securities. And Ginnie Mae releases performance data on all of these mortgages every month. So when, if a mortgage doesn't make if the mortgage doesn't make their payment that month, then that mortgage will go, if they were previously current, they'll go from 0 months delinquent to 1 month delinquent. And if they miss the next month, then you'll see that they're 2-month delinquent. So there's this huge amount of data that is publicly available. I mean, it's subject to some data use restrictions, but it's publicly available, for folks who have the ton of technical ability to bring it in. Now, this is not a privacy disaster. All of these mortgages are anonymized. They don't give you specifics on locale other than state, et cetera. So it's not, but you can see it at the loan level, which is important because that's where the stories ultimately start to emerge. So I'm taking in this data, figuring I'm going to present it to the subscribers to my Substack as part of the general macroeconomic commentary. Hey, what's happening in FHA loans? And as a result of doing that and publishing some of the stats, that's what kind of led me to connecting with Melody. She reached out and we had some good conversations about the data. And as part of that continuing dialogue, she asked me a really interesting question, which was, so for people who are getting modifications from the FHA, loan modifications from the FHA, or some other loss mitigation option like a partial claim, what's the redefault rate on those, right? I mean, look, borrowers struggle from time to time. Their loss mitigation is there for a reason. A borrower loses their job. They need a couple of months to find another job, get back on their feet. They can't quite afford to bring the loan to pay off the arrears and bring it current. So, okay, FHA gives them a partial claim. They bring them current, but they've got a new job. Now they can repay on the mortgage. Great. That's a success story, right? The borrower stays at their home. The FHA insurance fund doesn't suffer the loss that it could have. It's a win-win scenario. But if borrowers are redefaulting, right? Well, that tells a more ominous story. So, she's asked that question. I was like, I probably can figure this out from the data that I have, what the answer is to that. And as also part of that conversation, she is also like, I'd love to be able to just understand what some of the loan level stories are, which you can kind of only understand by looking at the data and looking at the performance history of a particular loan as it evolves over time. So Melody has, she's got servicing clients and she does she does some servicing reviews where she literally goes in and looks at, hey, what actually happened on a loan over a given period of time to make sure that the servicer's doing everything that they're supposed to be doing in the servicing of that loan. And so she's getting those loan level stories from, her client books, but not at the macro scale that I have with the data that I pull in from Ginnie Mae to look at that. So I kind of left that conversation in January. I was like, all right, that sounds, that's interesting. I'll go look into the data and see what I can find. And then what I started doing, Tony, is I started slicing and dicing up the data to see, because I don't remember what it was in last January. I think the delinquency rate in the Ginnie Mae pools and the MBS, which is the data, the 6.8 that I can see, I think it was running, let's just say 12%, 12% delinquent. And by the way, it's actually a little worse now. It's not 1 in 10 across the entirety of the FHA. It's probably more like 1 in 8, 1 in 7. It's a little more than 1 in 10 in the mortgage-backed security pools, but the portfolio that's outside, the million or so loans that are outside of pools that are on servicers' books, those perform considerably. Their performance characteristics are considerably worse, and there's reasons for that, because when loans go bad, a lot of times they have to pull them out of the pool for various reasons. But on par, if you look at the FHA delinquency trends report, which is a little lagged, but when it comes out, it'll be more like 1 in 8, pushing on 1 in 7 loans that are actually delinquent.
Okay, so let's pause for a second. That's incredible. That 1 in 7, 1 in 8 is now delinquent. And like, why isn't anybody besides, say, yourself talking about this, right? What's going on? I think maybe you're going to answer that because, and to back up a little bit, there may be some folks that are not familiar with a partial claim mortgages and everything else. But basically what we're talking about is that the servicers, and and I guess this goes back all the way back to the great financial crisis, and there was a lot of pressure put on the banks to create some type of resolution, some type of waterfall process, especially within the FHA space. In fact, when you want to do an FHA short sale, you still have to go through the waterfall process. The lenders, the servicers have to make the attempt to see if it's possible to keep these folks in the home. I'm all for that. The CDP has always been about, let's keep people in the home. And then when they fall behind and they reach out, or they get reached out to, and they say, okay, let's work something out, assuming you would hope that they're in a position to make the payments going forward, you have an amount of past due payments that are there, and those get bundled up and put as an additional loan in the back. And that is what is called the partial claim mortgage. So far, so good?
Yep. Right
now,
on track.
My understanding would be that, okay, we fixed it. Let's do this going forward. But then your numbers found that a large percentage of those people were redefaulting.
They absolutely were.
And then instead of saying, okay, let's put the brakes on this, what did you find that was happening that just kept people in their homes nonstop at taxpayer expense?
Yeah. So, and that gets into the loan level stories that you start to see as you dig into it, right? So as I started to look across the data to determine, well, what is this redefault rate? You look at it and for loans that had a modification, particularly a recent modification, you look at their redefault rate and it's like shockingly bad, like seriously shockingly bad. And then understanding what's going on with the partial claims. And the thing that's important to note about the partial claims is when somebody gets a partial claim, then the next month that loan becomes current. The partial claim cures the loan. I mean, it's the same thing if a loan gets modified, right? It was seriously delinquent before, but now that the FHA has effectively covered the arrears to bring the borrower current, then it becomes current again for a month. And then maybe the borrower keeps making their payments if it's kind of a good loss amid outcome scenario. But if they don't, then the next month, if they miss it, then they'll become 1 month delinquent and so forth and so on. And so that's a data signature within the data. And if I've got a data signature for a partial claim, then I can run queries to figure out how many of these things are happening. And it turns out that there's about 30,000 of these things happening a month, give or take. Some months it's down to 25. Some months this year it's been up near 35. Give or take, it's around 30,000 a month of these that have been happening. And then it becomes a question of, okay, well, let me go take a look at a couple of these loans. Like, where are partial claims happening on loans? And then I'll construct the loan's full history, and it's absolutely nuts. You see it in, say, like February of 2024, 0 months delinquent. March, 1 month. April, 2 months. May, 3 months. June, 4 months. July, 0 months.
Hmm.
They got a partial claim. August, 1 month. September, 2 months. October, 3 months. November, 0. They got another partial claim. December, 1 month. There are a fair amount of loans that were receiving essentially chains of partial claims. Now, some of the loans weren't as egregious as that. Maybe they got a partial claim in the spring, and then they made a couple payments, and then they went seriously delinquent again late in the fall. I got another partial claim. But you look at some of the loan level stories. I mean, there was one that literally got 14 partial claims. Like, they got a partial claim once every 3 months, over and over and over, like clockwork. Now, most aren't like that, but there
Right.
are a couple. And the reality of it is, when I run the partial claim numbers now, like, I have to go check my recent posts. Like, every month when the FHA numbers come out, I run the queries and see. But you're talking a third to half of these, I think half of them are repeat recipients of partial claims, and maybe 20-30% are on their, like, third or more. I mean, there's just tons of repeat usage of partial claim. And I mean, part of that is distress, right? There probably is legit distress. Part of that's
Right.
also probably just straight up abuse of the system, because, like, the FHA's loss mitt procedures completely allowed it. Like, it was wide open for this to take effect. Like, the only thing that really mattered for the borrower, like, if the servicer calls out to them when they're seriously delinquent, they're running a script, which is the procedures, the FHA loss mitt waterfall procedures. They start, hey, can you repay the arrears, right? Can you come current? No. Can you repay the arrears over time, right? If we spread it out over 12,
Hmm.
24 months, tack it on to the mortgage payment, a
Right.
repayment plan. No, I can't do that. Okay, well, if we brought it current, could you make the mortgage payment? And if you said, yes, I can, then if you had a partial claim pot available from the FHA, and that partial claim pot is 30% of the UPB when they get their first partial claim. So, most of these loans are still, like, real early in their amortization schedule. So it's like 30% of the loan amount. They can, in theory, get, partial claims that add up to that, which is how you get a guy get 14 of these partial claims, literally going years, 3-4 years sometimes,
Making a
without
payment.
making a payment, and just getting strings of those partial claims.
So John, what happens at that point when you have for example, the 14? Is it just the partial claim mortgages just get updated for a higher amount? So it's still one lien against the property, but that amount is just updated to reflect what
No,
they.
99% sure they got 14. They got 14 juniors if you were to go and check out the reporting offices on those.
And you know what? Something that a lot of folks don't know, in the case, a lot of these folks that go through this, and we started seeing this already from folks that got modifications several years ago, totally forgot about the fact that there was a partial claim mortgage. Then they go out there and they have equity. They want to go sell their home. Then they find out they don't have as much equity as they thought they did,
Right.
because they totally forgot about the partial claim mortgage.
That's right.
Now, it gets worse when they're underwater and they're seeking out a short sale. In the case of the partial claim mortgages, they don't settle those. You're not going to be able to settle those. If they owe 50 grand in partial claim mortgages, they're going to have to pay $50,000. So that means whoever's in the first position is going to take even more of a hit. Now, at this point, and the loan shows current, which means that the servicer or the investor behind the scenes is actually receiving payments. So is this money is being transferred, right? In other words, money is coming from somewhere to make those loans current, which allow people to live rent-free in their homes. Am I correct?
Yeah, that's 100% correct. I mean, like when the borrower stops paying, the servicer still has the obligation to forward, to advance the payments to the investor, whatever the scheduled payments were. So the servicer is out that money initially, right? Say they're 4 months behind, they do a partial claim, then the FHA pays the servicer, and the servicer is made whole. The loan is brought current. The junior lien is recorded for the whatever the amount of the partial claim is. But yeah, absolutely, it's the FHA who's paying the servicers.
And so the system is being abused now. I think one of the things that caught my eye was that is this something where the consumer finds out that these loopholes are in place and they're clever, they're creative, or is there something more, I don't want to say sinister, but there's another agenda behind the scenes, and that is that we didn't want to see a lot of foreclosures go on the market at any given point because that makes people afraid. Was this some kind of an artificial way of keeping the default numbers down and the foreclosure numbers down and just kicking the can down the road?
It's a good question, right? I mean, these relaxing these loss mitigation procedures to where you could get endless partial claims and you could get modifications that made 0 sense from a loss mitigation perspective. These programs came about during the you know late 2020 into 2021. So these are pandemic era programs, and you can maybe kind of see, the nation was still gripped to some degree by some of the kind of COVID hysteria back then, and this was part of that policy response. So maybe it started that way, right?
Mm-hmm.
But then it's 2025 now. We are long since past that. And definitely, I think, since then, continuing to have these super relaxed loss mitigation procedures versus returning to like real loss mitigation, which tries to help genuinely struggling borrowers, but is not, just this endless avenue where if the loan can't be saved, then it goes to loss mit disposition, and if that doesn't work, to foreclosure. There probably was some politics that was being played, because this tightening that is just happening now, which we'll get into, I'm sure, here later in the program, but that was originally supposed to take place in April, but the FHA on January 16th, I believe it was, extended it at that point in time to February of 2026. And in my Substack post on it, I said, I don't know what the motivation of the at that point Biden administration FHA was. But from a Machiavellian perspective, it would be pretty genius to push out the resulting fallout from the tightening of the procedures until the beginning of a midterm year. I mean, if I were,
you're writing a script for a
yeah, exactly. So yeah, I think, I don't think it began that way, but I do think that probably some of suppression / politics has crept into that policy response, or continuing it over the last couple of years.
Yeah, and I 100% get the intention behind it was probably very noble. Let's keep folks in their home. Last thing we want is people losing their homes.
Yeah.
But then again, once they just continue to go, I don't blame the servicers. If the servicers are out X amount of money and they know that they can get reimbursed, and all they have to do is follow the policies that are in place, they're doing what they need to do. So,
and it's even more than that. If they don't follow the policies, if they don't, do the partial claim playbook, then the FHA will come after them.
Oh, okay then. So I mean, they're going to do it. So that's what's been going on to now. So before we actually, well, maybe I'll ask you this question afterward. Now everything is changing, right? Or everything supposedly has changed effective October 1st, right? Just yesterday. What is that change? We've been kind of hinting at that and everything else, but I don't completely understand what's going to change. Maybe a lot of my listeners or people watching don't know. So what are we looking at supposedly now?
All right, so there's two really key things that are changing, or not changing, that changed on October
Mm-hmm.
1st. The first of which is the FHA now limits home retention workouts, which would include a partial claim. It would also include a modification. It restricts home retention workouts to one every 24 months. So as a borrower, if I get a partial claim that brings my loan current, I cannot get another partial claim, nor can I get a modification for 2 years after that,
Wow.
after that point. So, I'm going to have to pay the mortgage in that interim period, or that within that 2 year period, because if I don't, then I'm going to be facing loss amid disposition, or I'm going to be facing loss amid foreclosure. So that effectively completely stops the abuse
Okay.
of the partial claim. You simply can't get more than one within a 24 month
Yeah,
period.
that's huge.
It is, but that's not the only thing that the FHA has changed within the new loss amid procedures. The other thing that they've done is that they have mandated 3 trial payments for every home retention option, loss amid home retention workout that a borrower gets. So many people perhaps some of your listeners are familiar with trial payment plans in the context of modifications, right?
Mm-hmm.
The servicer does a loan modification with you, but then you have to make whatever that modified payment is going to be, which is usually a bit less, maybe 20-25% P&I less than what the earlier mortgage payment was, right? That's the payment relief to try to keep the borrower in the home. But this servicer or the investor, FHA or Fannie, Freddie, et cetera, whoever was behind it, they want to make sure that the borrower can really actually make this updated modification, or this modified payment, right? The lower payment.
Right.
So they try it for 3 months. And if the borrower successfully completes that, then the mod gets executed, and the borrower goes on with the modified loan from them, hopefully to continue making their payments. And if they don't, and they fail out of the trial payment plan, then that's usually the next step is pursuing a loss amid disposition option, either a short
Wow.
sale or a deed in lieu, or ultimately foreclosure. So what the FHA has done is, and understand that during these loose procedures, they largely weren't doing trial payments on any of these. You just got them.
Mm. They took the
And
word for it that they could make the payments. Oh, so you promised to make the payments. Oh, you can't afford it. That's
yeah,
good for us, right? Yeah.
yeah, 100%. They just
Yeah.
take your word for it,
Yeah.
and you're good to go. Now they have to do 3 trial payments, but not just on modifications. They have to do those on the partial claims as well.
Okay.
So now if I'm talking to you and I say, Tony, can you resume the mortgage payment if we cover the arrears and bring you current? If you say yes, you're going to have to prove it for 3 months. And if you can't, if you miss one of those regular mortgage payments, and you fail out of the mod trial payment, or not the partial
Yeah.
claim trial payment, then you actually are able to get evaluated for a mod that lowers your payments initially, right? But if you pass, of course, if you pass the trial payments, you make three payments, and then you go delinquent again, then you're prohibited by the one home retention every 2 years rule. So I guess the stark reality of it is, starting in October, um, borrowers have to make the payments
Yeah.
on these home retention options, or they're not going to get them. Which is so I've been reporting these nearly 30,000 a month standalone partial claims, and when the data comes out next week, which will actually be for September, I'll probably see around 30,000 more, and then in October I should see next to no partial claims happening, because you've got all of
Gotcha.
these trial payments that they're going to have to complete those, and they have to complete those before they get the partial claims. So we should see that number to collapse to whatever the actual natural cures are. People hit a
Okay.
winning lottery ticket or something.
Yeah. So let's talk about this also from a CDP perspective. The folks that are part of our movement is helping people stay in their home. I think one of the first things you identify when somebody reaches out to you or you reach out to them is what type of mortgage do you have? If they have an FHA mortgage, then by all means encourage them to speak with the servicer, but only after asking some very simple questions first. And that is, hey, look, what's your hardship? And if the person says, I lost my job, I can't afford it, then you know that that individual is going to have next to no chance of being able to go on the trial payments and make it. If they feel like they can, they should attempt that first. And maybe at the very least, they're buying themselves 3 months. But you should already have a plan in place to go ahead and say, look, if you do default, at that point, the only option you're going to have is to exit with dignity. That's a phrase we use within our movement. And that is, there's no dignity in being shown to the curb by the sheriff in a foreclosure.
Yeah.
That if you have no other choice but to leave the property because you cannot afford to live there, some of these people may actually be sitting on some equity. Why would you want the home to be foreclosed on when the other option might be sell it and walk away with as much money as you can?
Yeah.
But I have a bad feeling that more and more of these folks are going to be underwater. A lot of these FHA buyers, they went in with very little skin in the game. That's the whole point of FHA, only 3.5% down. And let's say they bought the home during the peak of the market, very little down. They've already started missing payments. Property values have stabilized in some areas, come down. What do you think, John? You think we're looking at not just more FHA defaults, but more FHA defaults that involve potential short sale properties?
Yes, I do. And just as a very, very quick backtrack, and I'll get to this answer in just a second. There is forbearance as a possibility for borrowers who have suffering a more temporary hardship that maybe they'll be able to find that other job. Although, and
Okay.
it's kind of a lesser known aspect of the changes, but forbearance is now at servicer discretion. So whereas before, if they were unemployed, then the FHA essentially mandated that the servicer would engage in special forbearance for the borrower. But now everything's at the servicer's discretion. So there is some opportunity for them to buy a little more time before they have to you know decide whether or not a loss mitigation retention option might work for them or not.
What would that forbearance look like in terms of like an example? How would it differ from trying to qualify for a modification and being on 3 trial payments?
Yeah, so in a forbearance, you're staying delinquent, right?
Right.
That's not being cured, but you effectively have an agreement with you and the servicer, where the servicer is not expecting you to make your payment. Or maybe you agree to a reduced payment, because that's what you can swing for a while you're
Gotcha.
maybe underemployed, looking to replace a second job or something to that effect. Um, the but the FHA has also made these forbearances more burdensome on the servicers to do operationally, and with everything that's going on now within loss mitigation, because the servicers are in FHA land are going to become very, very busy from a delinquent servicing perspective. It sort of remains to be seen how many extensions that the servicers will do on forbearance. The initial one is 1 to 3 months, but then after that it becomes fairly operationally a pain in the neck for the servicers to do. They don't have to. So,
Yeah,
at a
they're not
certain
forced
point,
to. It's extra work. They don't see the benefit of it. They might
Yeah.
just say no, no,
I mean,
thank you.
if the servicer really believes, yeah, hey, this person's going to get another job, but if the servicer's, doesn't think that, or that, like there's going to be less forbearance. Anytime you create friction and you make it more expensive for them,
Right.
it's going to be natural that there's going to be less that exists. All
But
right.
CDPs can present that as an option. They can say, look, if you haven't discussed forbearance with them, at least bring it up in conversation.
Yeah,
You know,
100%,
yeah,
particularly if the hardship is of a nature,
temporary.
yeah, that might be
Yeah.
recoverable from. All right,
Okay.
so to double back to the question that you were asking me, and can you remind me what it is? Sorry.
Yeah. About did you see that maybe we're going to see a lot more underwater
Oh,
FHA mortgages? Yeah.
that's right. Yeah, and absolutely we are. I mean, there's a couple of reasons. There's a couple of reasons for why this is happening. One, you were seeing home value declines, and I say across the country, it's like half the states in aggregate are declining, about half the states are not. If you
Hmm.
look at like Zillow's HVIs, um, but then you can't just even look at it at a state level. You really
Yeah.
have to go in and look at where are these things happening at a zip code level, because
Exactly.
there's additional dynamics in play in the locality. And FHAs are actually sort of particularly susceptible to being in zip codes where significant home value declines are taking
Mm.
place, particularly when you get into Florida and you get into the outskirts of the Texas metros, Vegas, Phoenix, etc. Um, and there's a reason behind there's a reason behind a lot of that. One of those reasons is you have a lot of FHAs that get originated on new builds. As the builders in the construction industry pivoted, and particularly in 22, 23, like they were building um, lower lower value, more starter homes, right? Because that's where
Hmm.
that's where the demand is, and they build these mass communities, right? Like you go look at some of the communities by Lennar, D.R. Horton out in the outskirts of Dallas, and there's you know hundreds, thousands of homes that all get built within a couple of year time frame, and the mortgages for those are typically FHA mortgages, um, and they are usually originated by the builder's lending arm, and that matters because for two reasons. Like, a it matters that of its location, because you get a concentration of FHA mortgages that all get originated between 2022 and 2024, because that's when the new builds got completed, right? If
Yeah.
you go into an existing neighborhood that's been around for a while,
Yeah.
I mean, some people purchased a home and used an FHA mortgage, and someplace closer to the city center in Atlanta, right? Where there's not like big new construction taking place, but you don't have hundreds or thousands of them
In
all
place.
originating mortgage within a 1 year, 18-month time frame in a zip code, because it just doesn't normally work like that, except when you've got 1,000 new homes that get built and finished all within that time frame. So that's one aspect of the dynamic. The
Hmm.
second aspect to the dynamic is builders builders play with price, right? Builders
Hmm.
would typically rather get a higher price, um, and
Mm. Throw
for
in
the same
concessions.
margin that they make. So
Right.
what they do is the lending arm takes a bath on the mortgage, because they originated at a point and
Right.
a half, maybe even 2 points lower than what market is. So prevailing rates are 7%. Great, we'll give you a 5% rate on your mortgage. And so the lending arm takes a loss on that, because they have to essentially pay to buy it down, and when they securitize it, they don't get back nearly the money. So like the lender takes the bath, but the builder makes up for it effectively by being able to sell it for a higher price. And the borrower, if if you're only looking at it from a price perspective, or not price, a payment perspective, the borrower might not care. It might even look to their advantage, because the lower rate gives them a lower payment than they would have gotten if they would have paid, I don't know, 15 grand less than what they
Hmm.
paid, but gotten a rate a point and a half, 2 points higher. It just removes their prepayment optionality, right? Like
Right.
they don't get the benefit of lower rates. The rates drop to 5, and well, they're still sitting with their mortgage. They can't refinance it. Whereas if they originated at 7, they could have. In any event, because the builders can do this, that ends up kind of artificially inflating what the
Waiting.
home values are, particularly during that, I don't know, 18-month time frame, 18-month time frame that that all these homes got completed. And now as we get beyond that, like the home prices start to decline, because if you've got a seller, I mean, and most people don't sell within 18 months, 2 years of buying a home, but some do. And if they do, they can't offer the same rate unless they get exotic and try to,
Right.
do a deal with assumption or that sort of thing. And as a result, the borrowers pay less. So you've got an aspect of that in play. Plus, you just had general speculative mania that was across the whole housing market and
Yeah.
up to
If I may, I think what you
2024.
touched on something great. That new home buyer isn't focused on price; they're focused on the payment.
Yeah.
So the payment is maybe higher. I mean, the price is higher. And if they have no choice but to sell within a year or two period of time, they can't expect to sell it for the same amount, or higher than what they paid for it. So they're underwater. And also, correct me if I'm wrong, I've also read that a study that FHA mortgages, as they sit right now, are very toxic levels of DTI, maybe even higher than they were back in the great financial crisis. We are giving people loans that are very, very risky loans right now, very toxic levels, correct?
The DTIs are higher, yeah, for sure. The
Yeah,
general credit characteristics of FHA now versus GFC is worse. It's not. I mean, there's a fair amount of truth to the FHA became the new subprime. I mean, that isn't always the case with every FHA origination, but
got
there's
it.
definitely a fair amount of truth to that. There's also, as part of those DTIs, there's a student loan angle in here as well, and with 7.7 million borrowers on the SAVE student loan repayment plan who are still in forbearance paying nothing. A fair
Yeah,
chunk of those are going to be FHA mortgagers.
right.
And when repayment is finally required, it's going to put additional strain on those borrowers' finances as well.
Yeah, my understanding is that effective now, they can actually start garnishing wages for people that are delinquent on student loans, and that
They
is a huge chunk. I
They
mean,
they absolutely can. And the key takeaway here for your audience is yes, that is happening. And yes, that is applicable to the people who are in default on their student loans, but there's still 7.7 of the as of the last Department of Education data in June, 7.7 million borrowers who are not required to make payment right now.
because
That
they're in deferment,
What's that?
because they're in deferment or something.
Administrative forbearance.
Okay,
It's due
forbearance.
to the
Okay,
it's due to the court case that and the injunction against the SAVE plan that the Biden Department of Education created, saying it didn't have authority to create it. So that's right now. Those are still in administrative forbearance, and at some point,
that's going to run out.
at some point they're going to require repayment, and when they do, then that's going to be an additional strain on the finances of
Yeah.
all of whom, and many mortgagers are in that set of people.
Okay. Hey, John, so I think that you once mentioned to me that you have a way of identifying where some hot spots are, whether it's regionally or by zip code or something about where maybe they're going to be a lot more defaults than others.
I do. Well, so I do. The heat maps that I put together and publish every month and update every month at my Substack. They're based both off of delinquency data. I also look at borrowers that have previously had partial claims because when you look at the redefault rates for borrowers who previously had a partial claim, they are 5 to 7 times higher than the default rates for borrowers who had never had a partial claim. So it bears huge. Like if you had a partial claim in the past, you're 5 to 7 times more likely to go delinquent than a borrower who originated a purchase mortgage 2 years ago. And I can actually pull one of these up and show you. I take.
And I'm going to encourage anyone that has a question to go ahead and type it into the chat area. We're going to open that up for a second. I know Anita's just posted a great one here that I want to ask John, but take this opportunity, folks, to go ahead and put some questions into the chat area.
Okay, so hopefully folks can see.
We see it, the Florida map.
Yeah, this is the Florida map. So when you see these, the shading of red here, and I think, yeah. So this is showing loans that started to just kind of first went underwater. So these would be loans that had a combined loan to value in the month previous. So it would have been July. That was where they were still above water, maybe 99 combined loan to value, which of course is still functionally underwater, right? Because any transaction is going to take probably 5%. But and then in the month of August, they slipped underwater. So this is kind of the new people who became underwater. And
could you go a little lower in Florida? I'm curious about the West Coast, like Punta Gorda area, and those people that were really affected by the hurricanes and everything else.
Yeah, you definitely are seeing it down there as well. At the website or at my Substack, I actually publish downloadable interactive heat maps. So you can download them. You just open them in a browser, and then you can zoom in and pan to whatever locale that you want. And depending on what the map, right? Maybe it's the new underwaters this month. Maybe it's just aggregate existing stock of where are the underwater, where are the FHA loans that are underwater, the confluence of these are where the loans are both underwater and troubled. They're maybe 2 months plus delinquent, or they previously had a partial claim within the last year or two. Those are kind of the borrowers who are most at risk of ultimately facing loss mitt disposition, right? I mean, maybe they'll be able to work it out in their one last shot at loss mitigation, starting already now in October. But if not, then those are the ones where short sales are.
So John, this heat map, is this just underwater or underwater that's also delinquent?
I published various versions of it.
Okay, got you. And you're going to put your Substack link in the chat area. Plus, we will also send this out, because we will be sending out the recording to everyone that registered and everything else, because people are asking in the chat how they can have access to your data, and that would be through your Substack, correct?
Yeah, that's 100% correct.
Yeah. And are you exclusively tracking FHA data right now, or are you also involved in any VA data? Because again, I'm very involved with the veterans and everything, and now we're seeing that protections and moratoriums that were in place for VA loans are now gone as well. So are you tracking that data at all?
I do. I also track the VA data every month, and I keep tabs on the Fannie Mae and Freddie Mac data, but the levels of delinquency in Fannie and Freddie up to this point are not really all that interesting. Like, it's largely fine. So I don't really write a whole lot about it. So VA, what's going on with VA? And VA is really interesting, right? Because you had the foreclosure moratoriums that lasted until last December, at the end or turn of the year is when they expired. So you effectively had no VA foreclosure activity outside of abandoned properties and that sort of thing over the last couple of years, and that was that was done in order to let the VA community, the servicing community, implement the VA servicing purchase program, which basically the VA would literally buy the loan from the servicer.
Yeah.
The VA would hold it on its books. It would modify it to 2.5% interest rate. It contracted with the servicer to kind of managing the servicing of that. And it was kind of like one last chance for the veteran, but it's 2.5% rate. So that could deliver um, payment relief, meaningful payment relief for almost every loan in the VA portfolio. And they did VASP on maybe 40,000, 50,000, 50,000 loans in the VA portfolio. Uh, but then Congress intervened, and with the change of the administration, the program got abruptly canceled in late April. I think it went till like the 1st of May. And then a few that were on trial payments, continued to filter in then. But at this point, VASP is effectively totally done. There's no more people who are coming into VA. And that's problematic because currently there's no VA loss mitigation option that can help almost all of the veterans. Like if you
Yeah.
have a low interest rate, then you have if you can't cover the arrears, then effectively your only option, and you can't roll them into a repayment plan, then effectively your only option is to do a loan modification, right? Because you can roll the
Right.
arrears into the new loan when you do that. But if you're going to raise the rate to 2 points, I mean, you're going to spike the payment on them.
Yeah, they won't be able. And now I read that an executive order was signed that could create the partial claim option on these
Yes.
loans. But
Yes.
then again, aren't we we want to help them stay in their home, but if they cannot afford the payments, we're just going to do a replication of the FHA partial claim, which is essentially kicking the can down the road.
It is, although the way that the VA Partial Claim Authority, so this is not just executive order. This is full-blown law, right?
Okay.
Congress passed a bill, and the president signed it, that gives the VA Partial Claim Authority. And this, I mean, literally, I think the president signed it in early September.
Okay.
So what that means is that the VA now has authority to create a loss submit tool to create partial claims that servicers can do. But those programs have not been implemented yet. And realistically will likely probably take another, I don't know, 3 to 6 months or so before they get implemented, and before they get, well, both implemented in rules and regulations, along with implemented in servicer technology. Like the servicers need some time to actually incorporate that. So there's going to be a period of time where there is effectively no option for veterans to receive loss mitigation that can possibly help them by curing the arrears, or potentially giving them payment relief. But a lot of, like, whether or not there's any option that gives them payment relief depends on how loan guarantee at the VA actually implements the partial claim authority that they've been granted. Congress has now given them the authority, but it'll be on the VA
We implement it.
policy making to
Right.
figure out exactly what the programs are going to be, and whether or not they'll look like FHAs or not.
Right. One of the questions here is the rule for FHA is effective October 1st, but what about folks that have already been modified and then go into default? Do they get one chance again?
They get one more chance. So that
They get
one
one more
out of
chance.
one every 24 months, it starts fresh on October 1st. So if you got a
Gotcha.
partial claim in September, then and I mean, it'd take you at least until January to be seriously delinquent, but you could get a partial claim in January, and that would be your one. And then from there, you can only get another home retention, partial claim, or modification every 2 years. So you'd have to wait 2 years after that before you could get another
Gotcha. Great. And Jennifer writes, John, I followed your insights on FHA workouts with my CDPE certification in 20 years in FHA REO. I'm interested in your take on the new 24-month restriction on partial claims. Do you see this policy actually reducing redefault risk or shifting the burden onto foreclosure timelines. So if I understand the question is, I think it's going to skyrocket the number of defaults, right? And then it's going to end up falling on the normal traditional loss mitigation avenues at that point. What do you think?
Yeah, it'll I mean it'll have meaningful impact on the read of. Okay, well let's just talk through what's happening, right? There are
Right.
two types of people who are getting partial claims. One are people who are in genuine distress, and if they're kind of perpetually genuinely in distress, then when you remove the crutch of just getting a partial claim every couple of months, then it depends on how they answer. If they're real with their servicer and be like, look, I probably need a payment break on this in order to make it work, then that might be possible. They might be able to do that by combining a partial claim and a modification, which the FHA does, right, in order to achieve the payment reduction. And maybe that's enough for that borrower, right? So in that sense, it'll if it is, then that'll help, right? But for borrowers that are not, then they can't stay perpetually in this partial claim or pointless mod loop where they get mods that raise the payment. They can't they can't stay in that loop. So that's going to push these borrowers into either loss disposition options if those are possible, right? Short sale or deed in lieu, or ultimately foreclosure. Um, and
Or if they have equity, it's just a regular sale. Let's just get the property
essentially, it's just a
listed
regular sale. That's
and
right.
let's get it with urgency, right? Because they
Yeah.
they may or may not have a sale date, and that's where again the CDP movement needs to get very active. I think it would be very helpful if we as CDPs can especially focus our efforts in the heat map areas that John has is publishing, because we can focus our marketing into those areas because those are the folks that are going to be most at risk, right? And I think that's just smart. I mean, we are licensed to do business in whatever state we're in, but find the zones that are the hot zones and target your advertising and marketing and prospecting efforts there. John, how much is your Substack? What options do they have, and how can they get started immediately with getting involved with your Substack?
Yeah, so my Substack, for paid subscriptions, it's $25 a month or $240 for an annual subscription. In order to get started, you just go to my Substack, and I regularly publish my paid research, including the data outputs from the maps, continually improving them. Right, I'm just on the verge of incorporating in the Redfin realtor type and realtor.com data into the heat maps to try to be able to present a more broad picture of that particular locale, not just what's going on within FHA mortgages, but then also what's going on from a real estate data perspective in that particular locale. And for those who can't, still encourage you to come by the Substack. I do occasionally do free articles, both in trying to grow my subscription base and as to a degree of public service, as well as to try to help
Gotcha.
to.
Do you have the link handy to post in the chat area now? If not, I can
Cool,
definitely.
thanks.
I absolutely do.
And as you're looking for that, I think probably my final question would be, what are the top 5 states that you would say are the most at risk, or you're seeing the most default activity right now that maybe isn't being reported as part of the data that's being put out there right now?
The top 5 states where
You're seeing that heat map really, really red up.
Yeah, I mean the top 5 states where you see those heat maps are Florida for sure. You see it where you would sort of expect on the coasts, and particularly in Central Florida, particularly in the areas south of Orlando. You also see it in you're starting to see it grow in the Jacksonville area.
Mm-hmm.
You see it in Texas, particularly out in the outskirts of the Texas metros, which corresponds in large part with where a lot of the new builds have been taking place. You see it in the Phoenix area. You see it in the suburbs of Atlanta. You're starting to see this in South Carolina, deep South, Mississippi, Louisiana. There's a lot of activity. There's not nearly so much up in the Northeast, like almost none at all with respect to underwater FHAs. And for the most part, the Midwest is pretty clean as well. But that's where it's happening.
Great. Great. And I just want to remind everyone, there may be some folks on the call or down the road who will listen to this. If you're not a CDPE right now, which is a certified distressed property expert, our mission is, help the folks stay in the home, whatever possible, by presenting options for them. But when they cannot stay in the home, how can we help them exit with dignity? We are in two different markets right now. We have people that have equity yet are losing their home, and it makes absolutely no sense to let the bank take the home when you have some equity, right? All you're going to do is have less equity when it's all said and done. And then there's the folks that we're finding now are underwater, and believe it or not, we are now getting people to wake up to the fact that yes, there are short sales. But there are people out there that have been saying, no, they don't exist. How can we have short sales when we're such an equity-rich nation? But are we an equity-rich nation, given how often people have tapped that equity? John, I have one of my agents that's working with a consumer right now, a homeowner that is a veteran and still current on his mortgage, but has done 5 refis in the past 5 years. And has pulled out equity every single time. Guess what? He's underwater now.
Yeah.
There's no way that he could sell the home right now and go ahead and pay off that loan. And folks, this is happening left and right. Wake up. We got to get people to wake up. The industry doesn't want to hear this. I'm going to get more detractors from this video, because I'm sure, John, you're getting all kind of hate emails and hate posts like, who are you, doom and gloom and everything else. And we're reporting the facts. This is happening. We can't pray it away. We can't wish it away. What we can do is mobilize and see how many people we can help. Because at the end of the day, someone that loses their home right now, if they're able to do a short sale, they can be a homeowner again in as little as 2 years.
Yeah.
Maybe 3 years. So why are we just kind of sitting back and waiting for the phone to ring? No, CDPEs, go out there, get these lists, start knocking on doors, start putting on webinars and Zooms targeted to consumers on what it is that they can do when they're facing foreclosure. And John, I can't thank you enough. What you're doing is amazing. I'm sure you're taking some heat as you're being praised on one end and taking heat on the other. But what you're doing is a tremendous public service. And I'm 100% you being able to do well financially by the good that you're doing. I'm encouraging everyone here to invest in your Substack. We need access to this data so that we can go out there and help as many people as possible. Do you have any final words for our group, John?
I guess 2. First, thank you. I appreciate it. And also, for folks who subscribe, I'm always taking suggestions for how I can improve the data that I'm bringing to you and the data in the heat maps to make it more relevant to and valuable to you. But the second thing that I want to say is, what y'all are doing is important. Foreclosure is a truly awful thing for everybody involved. It's awful for the taxpayers and who are standing behind the FHA insurance fund. It's awful. It's absolutely horrendous for the people who have to go through it. If a borrower is effectively destined to lose their home because they're just in a home they can't afford, it's so much better from a human kindness perspective, for that to be resolved earlier rather than going through a foreclosure process. So I just commend y'all for what you're doing. It's important work.
Thank you, sir. Thank you. And one last question. They asked, how often is your data updated? Is that part of your Substack? Is it a weekly or
So
monthly?
the data I update monthly,
Monthly.
on varying schedules, right? So the FHA data drops, 8th, 9th, 10th of the month. It depends. And usually within a day or two, I'll have heat maps that are showing kind of delinquency, what's going on in delinquency. And then once I get the HVI data that comes in, that's when I'll go and update the underwater. So it depends. I mean, for the most part, I'm updating this data on a monthly basis as I get the
Excellent.
data in and incorporate it.
Great. And we did post your information on there in the chat area. I'll make sure that we also include that information when we email this out as well. But you see it in the link. There's johncomiskey.substack.com. John, again, from the movement of the CDP, we can't thank you enough. God bless you. Keep doing the great work that you're doing, my friend. Thank you for being on the call with us.
Thank you, Tony. Really appreciate you having me.
All right, my friend. Thank you. All right, everyone. Thank you so much. Keep up the great work out there. Take care. Bye-bye.
Bye-bye.